Hey everybody, before we dive in, please take a minute and check out the link you see on your screen for a message from my sponsor, The Motley Fool. It's the best way to support this work that Tyler and I are doing, and you can get the top 10 stocks to buy right now. So, one of my favorite real estate companies has taken me on quite a roller coaster ride this year. Um, I'm talking about Redfin. So, I first bought shares of Redfin. They were trading for about $3.50 a share in late 2022. They rocketed back up to, they tripled at one point this year from that level and now have since kind of come crashing back to earth. They're now in the $5 range. So with Redfin scheduled to report earnings next week and my resident Redfin pessimist Tyler Crowe joining me, I wanted to answer the question: what should investors expect? Is Redfin's Are the numbers going to get worse before they get better? Are they going to get better? And just kind of generally what to look at. So the expectations aren't too high, and that's to be expected in this market. Redfin's really focusing on profitability now, like figuring out a way to make money from its business, which, novel idea. Um, but as opposed to just focusing on all out
What a
growth.
concept.
Right. So in the third quarter, for the third quarter, Redfin's expecting a net loss of about 21 to $30 million. That is Sounds terrible, but that's against a $90 million loss in the same quarter of the year before. So that would be a big improvement. And on an adjusted basis, having adjusted EBITDA of positive $4 to $14 million. Redfin has previously said it would be EBITDA positive over the next 12 months and have positive GAAP net income in 2024. If it can do that, I think even Tyler would agree that would be a big win for the company and its shareholders. The question is that a practical goal given how the real estate market is? So in the second quarter, there were some negatives that I think could get worse. Um, Redfin's market share dropped 8 basis points, which is a big deal in real estate because it went from 0.83% of the real estate market to 0.75%. You may have heard Redfin did like 3 rounds of layoffs. That's a big reason why. Lower agent headcount means lower market share. And Redfin now they got rid of the iBuying business, which they needed to do, but dropped their market share a little bit. Um, Revenue was down 21% year over year. Uh, the real estate market is it's at a crawl right now. Gross profit was only down 10%, so that's good. There are some positives to keep in mind, but I'll let Tyler be pessimistic for a little bit before I chime back in with those. Tyler, what do you think is going to happen for Redfin?
Well, there's a couple of things I want to see how they develop because I mean, let's just talk about the macro environment. There's a really good real estate writer, Bill McBride. He does calculated risk real estate blog, and basically, like every month, he just dumps loads of real estate statistics on you, and every month for the like past year, we're still seeing declining sales of existing home sales. And when it comes to home sales for Redfin or all the others, we're talking about existing home sales here. There's not a lot of new homes being bought or sold through Zillow, Redfin, or anybody like that. So again, on a macro level, we're expecting a slowdown, even more so than we've already had, simply because market share considerations aside, like just it's a smaller pie to come from. And so that is just, that's coming. So that's not great. And the other, you mentioned the decline in market share. And the other thing that is interesting about that too is that it had a couple, I think it was like 2 years ago, they bought a loan company, Bay Area Mortgage, basically looking to originate mortgages, kind of attach mortgages to the sale of the home. It's kind of Zillow's been doing the same thing. It's kind of both of them elbowing in to try to take a bigger share of the transaction in real estate. You've seen some talk about like escrow services, title services. They haven't quite come out with those yet, but the assumption is that someday they're going to. But in the second quarter too, they actually saw a decline in attachment rate. Attachment rate is how many homes sold through Redfin actually had a Redfin mortgage tied to it. And in the second quarter, it went from 20% in the previous quarter to 19%. So it's, we saw a slight decline in market share. We saw a slight decline in attach rates. And now I know that management has said that they want to focus on profitability, and that, perhaps they are foregoing the homes of certain sales because they want to boost the profitability on each sale. That's possible. And I'm not going to rule that out, but sometimes there's, what management says and then what the financials say. And I'd like to see how that reconciles, right? Is that a continuation? Are we going to see continued decline market share? Are we going to see decline or an increase in attachment rates? Those are the things that I would be looking for. And then the other thing that I'd be most interested in too is, we talked about its iBuying a while ago. And it's sold it off. If you look on their balance sheet, they don't have any inventory left remaining from the sale of its iBuying business, but they still have quite a bit of the long-term debt left over from it. When it started to really take on that business, like in 2021, they levered up pretty considerably, up to about $1.1 billion in debt. And so far, they've brought it back down to 830 million, which, it's a decent decline, but that's still quite a bit of debt carrying relative to the rest of the business. And so I am curious how management does plan to address its debt load, because absent strong growth over the next couple of years, I know, like you said, they want to be adjusted EBITDA neutral or profitable, but EBITDA means that it's absent interest payments, which means it's not really considering the debt that's on the balance sheet. And so all of those things kind of just they're real unknowns for me right now. I'm not going to rule out the possibility that it can fix those, but they seem like real problems that I haven't seen material improvements yet. And in this earnings report coming, I want to see how that actually plays out.
Yeah, that's fair enough. I mean, if the real estate market stays the way it is, I think gap profitability is a lofty goal for next year.
Yeah,
I
I
think
think
that,
that seems like everyone's assumption that the real estate market was going to improve, and
right,
it
that
hasn't
was
yet.
definitely part of it. It hasn't. It's gotten worse. Mortgage rates in the U.S. hit 8% for the first time in over 20 years recently. Just to name one thing that's slowing it down more, there just aren't houses going on the market. And I mean, as a homeowner, I have a 3% mortgage rate on the house I'm standing in right now. Even if I wanted to move, like I would list this, lose my 3% mortgage rate, have to buy another inflated house, where the price tag's gone up, 40% in the past couple of years, and get an 8% mortgage on top of it. Why would I
Yeah,
want to do that?
you're not leaving.
Um,
They're going to tear that house from you from your cold dead hands before you're
yeah, no,
trying to get
I
an
mean,
8%
the
mortgage.
the people selling their houses right now, either like you said, have died, and the house is being sold, or they have to move. Like there's some subset of the population that has to move. Maybe they got transferred for work or something like that. But for the most part, people aren't selling their house unless they have to. But having said that, I want to mention some positives. Well, you mentioned the mortgage business. This isn't a positive. Um, they couldn't have timed that purchase worse. They bought Bay Equity home loans at a time when everybody was refinancing. And everybody was taking advantage of low mortgage rates, and there was great volume in mortgage lenders. They bought it around the same time when Rocket went public and a few other big mortgage lenders went public. It just poorly timed transaction. Now, I can't fault them for timing a transaction wrong any more than I could fault you for timing a stock purchase wrong. They made the best decision with the information that they had on hand. A lot of people were predicting 2 years ago, the Fed predicted that at this point, the federal funds rate was going to be 1% at this point, as we're talking. So obviously that didn't come true. So they made assumptions based on the information that they were hearing from the people who make policy. So having said that, mortgage cross sell has actually been kind of successful. It's up to 19% attach rates versus 8% when they were just kind of their own mortgage operation and didn't acquire Bay Equity yet. The platform is still very strong. User traffic, active users on Redfin, it's essentially flat year over year. And given what's happened to the real estate market, that's a win. Maintaining your traffic and interest in real estate and things like that, despite the market, not doing anything. They've about 53 million active users on the platform. That's still pretty good. The Redfin Premier brand launched in the first quarter that targets $1 million plus homes. which is an area of the market that's still actually doing well because there's a disproportionate amount of cash sales at that level. So that area of the market is still relatively active, and it's looking like a success so far. Um, Gross margins are trending in the right direction. And you mentioned Redfin's debt and that the EBITDA is before interest payments. They still have a lot of interest, but they successfully got a new credit line and refinanced their debt, essentially making debt not an issue till 2028, which was a big win this past week. So they have the financial capability to make it through a tough real estate market. I think we could both agree on at this point. As long as the market doesn't remain terrible through, 2026 or whenever, they have the ability to make it through to the other side. So I think it will get better, but it could get worse before that. You think that's a fair way to sum it up?
Yeah, I think that's relatively fair. I am curious at such a low price, market cap, whatever, if somebody doesn't swoop in to actually acquire it. This to me, this almost looks like we're heading into the prime. We hear the announcement that CoStar buys Redfin or something like that.
Yeah, it wouldn't be a bad move for like a CoStar or even Zillow. I mean, I think you and I talked about Zillow's cash a few times. I think Zillow has enough cash on its balance sheet to buy like 5 Redfins right now. So it wouldn't be a terrible acquisition. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.